watching CNBC-TV18.
Stocks trade in a range as mixed earnings picture and economic uncertainty instill caution. IT and consumer discretionary gain while realty and metals drag. The mid-caps underperform.
Axis Bank reports strong margins, good return ratios and an improvement in asset quality, but weakness in its deposit franchise sparks concerns.
Gland Pharma misses growth expectations. Tata Communications fails to meet margin expectations, and Container Corp sees a drop in EXIM business. But Poonawalla FinCorp surprises on book health and profit growth.
And order wins provide a fillip to Dilip Bilkon, NBCC and Welspun Corp, while a new CFO appointment boosts Nykaa, and Sterlite texts kids on the likelihood of a rights issue. Hello and welcome to Halftime Report. I'm Sonal Bhutra and with me are Sonia Shenoy and Mangnam Malu. Hi guys, good afternoon. Well, we're starting the show with Nifty slipping in the red. It is at the day's low, 80 points off the highs of the day. So we're not able to sustain those higher levels, and that is something which is key to watch as well. Bank Nifty is the one which is underperforming today. We have cuts of around 77 points there, and the mid caps too. They are declining. That's a 0.4% cut right there. Advanced decline ratio in favor of the declines, guys. Oh, absolutely. And it looks like we have a lot of managements coming through this afternoon, so we can perhaps start off with them. First up, we have Gravita India, which is surging in trade after reporting a good set of Q3 numbers. The revenues are up 42%, but the margins have contracted slightly. Yogesh Malhotra, who's the director and CEO at Gravita India, joins us now to speak about the business as well as the way forward. Yogesh, thanks a lot for being with us in the show. Very good top-line growth, and across businesses, whether it's lead, aluminum, plastics, things are looking quite good for you. Do you stick to this volume guidance? I think earlier you had said you're confident of doing 25% of volume growth in FY23. Would you stick to that, and what's the outlook for the next year?
Yeah, absolutely. Good afternoon to everyone. And I think that whatever targets that we have had, we are very confident of meeting those targets. And not only for this year, in the coming 2 to 3 years, we are very confident of meeting this 25% volume growth year on year.
Will grow 25% volumes for the next 2 to 3 years. Is that what you're saying?
Yes.
All right.
Yes,
and
absolutely.
What about margins? You've said will consistently be in the 8 to 9% band. Do you see any further upside from here? And value-added products, you said your aspiration is 50%. This year, how much does it end at in terms of contribution?
So around 42 to 43% is the value-added products in our kitty right now, because we are constantly increasing our volumes also. So for any new plant, it takes some time to incorporate value-added products in that plant. So, but our target is to have more than 50% value-added products in the next 2 to 3 years. So that will, of course, increase the EBITDA margins for us slightly going forward, as would economies of scale as we are increasing our capacities everywhere. So both of these will increase the EBITDA margins in the coming 2 to 3 years.
Okay, Mr. Malhotra, what would that improvement be? 8 to 9% is the earlier guided band. In next 2 to 3 years, what kind of percentage point increase are you seeing here because of the factors that you mentioned?
So although the EBITDA margins currently is around 9%, but we are more focused on EBITDA per ton basis, because revenue numbers can change based on the metal prices. But our target is to have, currently we have a EBITDA margins of around 17,500 rupees per ton on a consolidated basis across all verticals. So we believe that there is a possibility of increasing it by 1.5 rupees per ton.
Okay, 1.5 rupees per ton.
1,500 rupees per ton is what you mean? Is that so?
Not immediately. In the next 2 years, that is.
In the
next 2 years.
Percent or 1,500 rupees per ton?
Rupees.
Okay.
Sorry, yeah, 1,500 rupees per ton. Sorry,
1,500 rupees per ton. Got that. Sorry. Tell us.
1.5 rupees per kg.
Okay, we generally talk, numbers and of course, very granular details. But if you can just take 2 steps back and tell us how is the overall business shaping up, especially in exports? Because I think 40% of your revenue mix in 9 months of this year has come from the export business, and many markets are under pressure. Are you facing the heat as well, and what is the outlook?
Not actually, because we are marketing across the globe and not only in India. But we have this because we are our operations are on pan-India basis also, as well as across the globe. So we have this flexibility of shipping the products wherever the markets are good. So if you look at currently probably European market is not doing as well, but that is on both supply as well as demand sides. So for us, actually, it's an opportunity to ship as much as possible to the European market as well. So for us, there has not been any negative impact of the slowdown in the European market, as well as the India market is growing. So, and we have this opportunity. We've done it in past also, as we have our operations in India also. So we can divert if there is any issue in any particular market. We have this flexibility of diverting it to other markets also.
Okay. So will you be looking at that? Can you tell us which are the markets where you could be perhaps facing some pressure in the near future? And when you talk about diversification in export markets, what can you elaborate?
See, for us, actually, it's the volume. If you look at our overall share of the market is very small. So overall changes in markets does not impact us that much. But as we have plants, for example, in West Africa, which cater to the European market. Similarly, we have plants in Americas. We have in India also, and in East Africa also, which cater to the Gulf market. So for us, it does not make any difference if one particular area or region does not perform very well. Overall, it does not impact us at all.
Okay, so diversification is
like,
helping
for example,
you.
the China has not been very good this year. Yeah, absolutely.
Right.
Geographical diversification is helping us a lot.
Okay, so Mr. Malhotra, 2-part question here. Last quarter, you had been able to reduce your debt. The last known number is around 300 crore rupees. Can you give us the updated figure here? And you had plans of, tapping the equity markets, raising money via QIP. Is that still on the cards? Are you looking to fund your expansion plans via any of these ways that I mentioned?
Yeah, so we have a plan of growing at around 25% year on year in the existing verticals that we have of lead, aluminium, and plastic. In addition to, and for that, we would require around 80 crore rupees per annum for the next 3 years on an average. Apart from that, we have a plan to get into new verticals also, like lithium ion and paper are the two, immediate in the immediate future, and we are also eyeing copper and steel recycling in future. So for this, we would need around 200 to 250 crores of fresh, money. Our focus has always been on keeping the debt equity ratio of less than 0.75 and a debt EBITDA ratio of 1.5. So we are very comfortable in that currently. But in future, if required, we could go in for QIP at an appropriate time.
Right. You said 250 crores the capex that you're looking to put in for new verticals, recycling, etc. immediately. What is the asset turnover on that? What kind of additional revenue can this bring you?
So for any in our recycling business, we get around 8 to 9x of revenue from the capital expansions.
So this could be a 2,000 crore opportunity is what you're saying?
For new verticals, yes.
Oh, okay, all right. Well, the street definitely likes that. The fact that the India business is growing well, you're confident of meeting 25% volume target, and you're not affected majorly by any one market. So that's a good thing in the export market is what I'm talking about. Thanks a lot for joining in. That's Gravita up 6.5%. Let's slip into a quick break. But when we come back, Sunil Reddy Dodla, who's the MD at Dodla Dairy, will be joining in to discuss their Q3 numbers.
Welcome back. Let's talk about another set of earnings that came by. Dodla Dairy was the one that posted a mixed set of numbers in the third quarter. The revenues grew about 17.5%, but it was the EBITDA which grew just 3%, and that meant there was some margin compression. We do have with us Sunil Reddy Dodla, who's the MD at Dodla Dairy, joining in now. There are a couple of reasons which we can attribute to margin weakness. One was you had increase in cost of milk production. That was one. Secondly, your contribution from value-added products came down both quarter-on-quarter and year-on-year. And thirdly, the flush season does not look good from a cost of acquisition perspective going forward as well. So what kind of margin guidance can you give us? This quarter, you did about 7.9%. Going forward, where does it go?
I think we'll sort of maintain the same margins. Like you rightly said, the reasons were the procurement price increase and the flush season not happening. And regarding to our VAP, actually, our other VAPs did well. But since lack of milk and we had a little bit of shortage of fat, which is reflects in terms of our sales of ghee, we had to pull back on our ghee sales of large format consumer ghee SKUs of the 5 kilos and above, and we kept it to a lower end of the SKUs. That's the reason we see a slight dip in our value-added products. But by and large, the other value-added products did grow and compensate for the drop in ghee. Otherwise, we would have had a 1% higher value-added product sale. So that's the reason on the value-added product side. Going forward, like we anticipate that April, May, normally a few of the states where the monsoon set in a little earlier, that the volume of milk will come up and it will ease out the current scenario, is what our anticipation is. Even without that, we will continue to maintain similar trends for the next quarter.
Okay.
That's what we've been maintaining in the past quarter.
Okay, all right. So can you give us a sense of what the contribution from value-added products be, since quarter on quarter in percentage terms it has declined? Will that be the range that you're looking at? And in terms of increasing your capacity, your expansion plans, what do you have in place? What kind of capex plans have you strategized for your company?
So for our capex plans for the current year, we had already taken on a new feed plant, which we're anticipating to come into production by April of the year 23. We have just finalized an acquisition in Kenya, which we will be acquiring, and hopefully we will be able to finish the acquisition by end Feb and get it into production and maybe by the first quarter of the next year. We had acquired Sri Krishna Dairy in the current year. We had also done a little bit of expansion on our procurement network, as to say that number of chilling centers we have increased and created a new smaller collection centers across 22 villages, or 22 centers as we would call it. So that's what we have done. And going forward, we'll be actively looking for both if there's an opportunity on the green front side or on the M&A side, greenfield or an M&A side. I think that is always an option that is open. I guess with the current stress in the system for the dairy industry, we are anticipating to get a few opportunities, hopefully in the next year.
Actually, we have a couple of questions on that. You said stress in the system. Are you talking about the competition? Because, you know, there are large corporates that are entering into this space. There's definitely going to be a lot of undercutting competition as well. Is that what you fear? And if you're looking for acquisitions, anything in this calendar year that you could complete?
This calendar year, we're actually having a couple of options in hand, but I think it's a question on what price we get it at, and that is going to be delayed. So that's keeping it there. But from a competition point of view, I think when you look at it, even as a large companies entering in, we'll actually are not very worried about it, because we are also very strong in our procurement. As we've gone forward and been saying earlier, we've been able to procure milk directly from the farmers. We're improving. So being in the dairy segment, procuring of milk is as crucial as much as selling of milk. Therefore, I think we will not have that much of an issue going forward with competition. It is morely going to be an issue of availability of milk in the system if our growth continues to be higher, and we have to balance it with the right price of procurement. And that is what we will find more of opportunities for us as we go forward, rather than the competition worrying us.
Right. You know, just a few things on this itself then. Can you give us a sense of what exactly is your current market share among private players and the market share in the overall market? Can you give us a sense? How has it changed over the last 12 months or so?
Basically, our market share is almost, because the market is so large, even a 1% difference means for us in terms of volume, a very large volume. So we are maintaining the same market share in terms of what we were earlier. But the growth of the market is what we have been able to add on to ourselves, and a slight increase in market share. Specific numbers are difficult to give because it's a very vast, areas, and people's definition of areas change a lot. So that is what it is. But we are continuing to maintain the similar market share. but the growth is coming from consumption growth increase and small market share increase.
And on the acquisition itself, I wanted to know, are you looking to acquire capacities or are you looking to acquire companies which are in certain categories? What spaces are you eyeing?
So basically, we look at acquisitions on basically to enter into newer geographical territories is one way we look at it. And the existing geography territories that we do have ample capacity of our own. It was all built up for more volume to be handled. I think because we cannot build capacity for the short term, we have built capacities for a little longer term. So for the next couple of years, the existing capacity that we have in our existing areas is adequate. We will be looking at going into newer geographies with our expansions, acquisitions or greenfields.
So I didn't get the outlook for FY24 in terms of what the revenue growth could be. I think I missed that. I don't know if you mentioned it. But you want to just give us what the guidance could be for FY24? If numbers, fine. If not, then you can even tell us, what are the big triggers that you're looking at?
So basically, if you look at us historically, we've been growing by 10% by volume and 15% by value, 3-4% coming in from either the product mix in terms of more value added, giving us more of revenue. So going forward, we are sure of at least achieving that basic, what we have been doing from the past. Historically, the 10% by volume, 15% by value growth is something which we will be very confident of doing going forward. It will be a little higher in terms of revenue because we're adding a little more portfolio into our value-added product range in terms of our ice cream and other products. So I think at least the 10 to 15% we can look at. Okay. 10% by volume, 15% by value.
Okay, 10% volumes or 15% value. Last question before we let you go. I wanted to know how big can the animal feed business be as a percentage of revenues going forward, because India continues to be a big market in this segment. How much will it be for you in that case?
So we are anticipating in the short term for it to contribute 300 odd crores for us in revenue as we go forward in the near short term of the 2 to 3 years time that we go, and maybe it will be contributing the same 5 to 6% of our revenue.
Okay, all right, Mr. Dodla, thank you so much for joining us and giving us all those details. Time for a break now. Up next, we'll connect with Jonathan Hunt, who's the CEO and MD at Syngene International, to discuss Q3 earnings. Stay tuned. Welcome back. You're still tuned into Halftime Report on CNBC-TV18. Nifty is absolutely flat, as I earlier pointed out, 80 points off the highs of the day. And it's the IT pack which is doing well in trade. That's the top gainer as far as sectoral moves are concerned, followed by Nifty Auto. A lot of auto earnings which are in focus. Maruti is something which is expected to report numbers today, so that index is doing well. On the flip side, we are seeing this big decline coming in Nifty Realty. So that is the top loser, down 1.5%. And the PSU banking index too is down 1% in trade today. But let's move on and talk about one more corporate that is on our radar today. Syngene International reported a mixed set of Q3 numbers. Revenue is up 23%. It has missed Axis estimates of around 27%, but the company has reported over 20% growth for the second consecutive quarter. Jonathan Hunt, who is the CEO and MD at Syngene, is joining us now to discuss the earnings and the outlook going forward as well. Jonathan, good afternoon. Thank you so much for joining us. Well, it's been the second consecutive quarter of 20% growth for the company. For this time around, this 23%. Can you detail to us which are the segments that did well for you? What is the growth in all of your verticals? And is this something that you'll continue to report in coming quarters as well?
Yeah, I'm pretty happy with the results, actually. We started at the beginning of the year. We got quite a strong first quarter that prompted us to upgrade our outlook for the year. Second quarter was solid. Third quarter's continued that trend at 23% revenue growth. So we're pretty optimistic. Sets us up for a busy fourth quarter and on track for our upgraded guidance for the year. The balance across the different divisions, so we have a discovery services division, we have dedicated sensors, development and manufacturing. It's nicely balanced across all four of those. And we're seeing good demand in the major markets for us. That's the US, North America, and Europe. And they're showing pretty good sort of acceleration in demand coming out of the pandemic. So pretty happy in terms of the demand environment, certainly very happy about our own performance in the quarter, and it puts us on track for a good year overall, albeit a very busy fourth quarter.
Can you give us some indication of what you mean by a good year, especially in the CDMO segment, which is the contract drug manufacturing segment? the revenues have been quite lumpy. Can you tell us what was the growth in this quarter there and what is the kind of sustainable growth you see in the full year?
Well, I can comment around it. We don't actually break out segmental reporting, so I'm not about to break down the P&L. But that's the nature of the work. I mean, manufacturing projects tend to be long cycle, and you can see differences quarter over quarter. I think the key thing for us in the manufacturing area was actually the regulatory inspections we had in the quarter. As you know, we've been investing for the last few years in building a new manufacturing business in biologics. One of the key gateways you've got to do there is pass regulatory inspection. And we had not one or two, but 3 regulators inspecting us in this last quarter. That was the US FDA, the European Union, EMEA, and also the UK, MHRA. All 3 left with a very positive, I think, perspective on our operations, and all 3 regulatory hurdles were cleared. So that's a key enabler for the year we're about to go into. We had to pass those inspections to be able to take that business forward. So we're pretty happy with that.
Right. Jonathan, you know, if you could simplify your revenue growth for us, 23% growth in the third quarter. How much of that has been on account of the depreciating currency? How much of that was organic, constant currency growth? And on the guidance itself, how much of Librela is factored into the high teens guidance for FY23?
Yeah, good. Well, let me deal with the second question first. Not a lot. I mean, Librela is really an issue for the next financial year and beyond. It's a 10-year strategic partnership, so we're really going to operationalize that in FY24. The enabling of that was in this year, and particularly the regulatory bits, but it's not driving this year's revenue to any great extent. On the currency, we've got a tailwind because of the way the business operates on currency. Just about all of our contracts, all of our business dealings at the revenue line are done in US dollars, and then we repatriate into rupees. So that structural depreciation that you see of the rupee to the US dollar, is a constant sort of benefit for us. In a normal year, we'd expect 3-4%. In the last quarter, year over year, we had about a 9% boost. So there's probably about a 4 or 5% on top of what we would have normally expected.
Okay.
But yeah, it's a real tailwind for us.
Oh, it is. So on that Librela, I had a follow-up question. Once it actually commences in terms of production, what are the peak revenues which you are expecting from this product? And at what stage of production is it currently?
Okay, so we're in the qualification period. We're starting to work through that. That was why the regulatory inspections are important. The deal overall is a $500 million US dollar 10-year contract. As for what the sort of demand will be in any given year, that's something that really will be determined by our client rather than us. But it gives you a general sense of it. It's just strategically important and a big opportunity from a Syngene perspective.
Okay, that's a big opportunity. You've recently expanded your manufacturing agreements with many companies, with the animal health companies, Zoetis, with BMS, Amgen. Are there any more expansions that are likely in the near future?
I hope so, and I'll happily report about them when they've happened. But as I said, it's a good demand environment at the moment across discovery services into development and manufacturing.
Virtually at the end of this financial year, and you are obviously on target to meet your upgraded guidance of high teen sort of growth on your top line. But next year, you do have a lot of tailwinds coming in from the Librela deal, the Zoetis deal, etc., which my colleagues just spoke of. So do you have any sense, any indication or any expectation of how FY24 is likely to be for you?
Yeah, I think we've got some positive momentum in the business. I'd expect to continue that into next year. So an outlook that looks, at least as good as this year, maybe better.
So at least high teen sort of growth, at least 19% growth, and more if some more deals like you promised would come by.
I would have thought so, but we'll calibrate that at the full year results.
Okay, all right. Thanks a lot for joining in and all the best. That's the word coming in from Syngene. Now it's time for the CNBC-TV18 budget quiz. Remember, there are prizes to be won every day. We give you the question at 9:14 today, but in case you missed it, here's today's question. What was the projected nominal GDP growth for FY23 in the last budget? Your options are A, 10.9, B, 11.1, C, 11.9, and D, 12.1%. Send us your answers on Twitter. Post your answer as a comment on the question tweet on CNBC-TV18 News. Use the hashtag budget with CNBC-TV18. Now hurry and send us your answers. Remember, we'll announce the winner at 3 p.m. today. Welcome back to Halftime Report on CNBC-TV18. It's a quiet day so far, actually. The Nifty is facing resistance at that 18,200 mark, which was the high of the day. Since then, the market has come off. Remember, the high of the 3rd Jan high was 18,230. Every time the Nifty gets to the higher end of the range, there is some reason for it to fall. Today, of course, it's banks. But all eyes will be on the US two-day Fed meeting that kickstarts tomorrow, Jan 25th and 26th. Market is expecting a 25 basis points rate hike, so perhaps just a wait and watch mode over there. This afternoon, if you're tracking individual pockets, then you should look at mid-cap IT. All the stocks are buzzing in trade, and tomorrow you have Tata Elxsi coming out with numbers after the strong showing from the likes of Persistent, Cyient, etc. I'm keeping my eye out on Tata Elxsi. And talking about Tata Group stocks, Tata Motors is the biggest Nifty gainer right now ahead of its earnings tomorrow. It comes out tomorrow evening, but there is buying interest, perhaps because the numbers are expected to be quite good. Both JLR and the standalone business will have a strong showing, and that's the reason why the stock is up and about. So these are just a few snippets, but what are you looking at in the F&O space?
In the F&O space, the one thing that stands out is the fact that we've been trading in a very narrow band for the last few trading sessions. In fact, if you just take a look at the Nifty trading range over the last 4 trading sessions, it's not crossed more than 150 on any of the days, and 150 has been the highest. In fact, on Jan 19th and yesterday itself, the range itself was less than 100 points, and today it's even narrower. Despite the dip that we're seeing on the Nifty, the high today on the Nifty is 18,201 and the low is 18,114. So that's about an 85-point range. You spoke about resistance at higher levels. If you look at the technicals itself, the 50-day moving average is an important resistance, not only for the Nifty, but the Nifty Bank as well. That's where it was facing some resistance yesterday. And today, that resistance has led the Nifty Bank to underperform, down almost 50 points for that index. So when usually the markets are in a narrow range, the option writers try to write both a call and a put, try to eat the premium that is on offer in the range. And 18,200 seems the obvious choice right now. Tomorrow is the Jan series expiry, 55 lakh shares added for a premium of 30 rupees in the 18,200 call. If you take a look at the 18,200 put, the premium on there is close to around 85 odd rupees. Okay, 80 rupees. So if you're selling both the 18,200 call and a put, you'd be looking at a 100 rupee premium that you would get while selling it, and you would expect the Nifty to be in that 18,100 to 18,300 range. And the 18,150 put writers too expect that 18,100, of course, would be a bit of a support, and 18,300 is the resistance. So range-bound markets and option writers make money.
Okay, so we take that point and we keep tracking markets for you. Thanks for that, Mangala. For now, we'll slip into a short break and we'll get you more on markets and stock-specific action. A lot of them buzzing around in broader markets as well. Stay tuned. Welcome back. Some recovery in the markets. The Nifty is up 14 points as we speak. The Bank Nifty as well, which was underperforming that index too, is slightly recovered from the lows. But of course, that's not a major recovery that we are seeing. The mid-cap index too is down 55 points as we speak. A couple of names in the broader markets which are at the day's high. We have BEL. That stock is higher. That stock is lower but is at the day's high right now. NCC is the other one which has surged to the day's high. So a couple of these pockets which are in focus right now. We also have ONGC. That stock should be on our radar. That too is in focus. Of course, higher crude prices is what we are seeing, and gas prices too, they continue to be higher. So that stock is higher by 0.2%, so to say. But again, it has fallen a little bit from the highs. We'll do one thing. We'll take a short break now. On the other side, Manisha Gupta joins in with Sumit Gupta from McDonald Pelz Global Commodities. Stay tuned.
Welcome back, and joining us on the show now is Sumit Gupta from McDonald Pelz Global Commodities. Sumit, hi, good to have you. All-time highs on wheat on a constant basis is what we've seen for the last couple of months now, and we're trading above 3,200 rupees per quintal. What is your sense? What do you think the government's viewpoint is with the wheat prices at all-time highs?
Hi, good afternoon, everyone, and thank you, Manisha, for having me on the show. It's a very pertinent question because India is one of the fastest growing economy in the world. And what the citizen of the country of the fastest growing economy wants? They at least wants a consistent supply of the food grains at affordable prices. And that's what RBI has also come up with their report, in which they have highlighted that tail end inflation can be higher than anticipated by RBI. But let's put it this way. Government of India till now has done a great job because by banning exports on 13th of May in a timely way, otherwise inflation could have been higher. They have substituted rice with wheat in the domestic market. But even after all these steps, domestic prices, as you have mentioned, today is trading at 3,200 rupees per quintal in Delhi market. And this price was 2,750 on 1st of Jan. So we have almost seen an increase of 20% in last 24 days, and which is actually hampering the consumer. It is hampering the pocket of the people. And if you look, who suffers the most? It's the consumer who suffers the most. So government of India has done a great job in certain aspect, but has not done a great job by going into policy paralysis, by not having OMSs at the right time, by believing in their crop number, and waiting for the next crop to do the wonders.
Sumit, when you would you say that the government would of course be concerned? They've banned exports, as you mentioned. OMSs looks like a very bleak possibility now, because even if the tenders were done today, it takes 30 days to come into the market. So that also seems like a far-fetched idea right now. And the concerns are for the 1.5 month now, because then the Rabi crop would start coming into the markets as well. What is the step that you see the government taking now? Because the import duty waiving also is not going to help, because that's going to also take time for the wheat to come into the markets. So what is it that perhaps the authorities could do?
It is, you have actually put all the answer in form of the question. I will put it this way. It's a great question, because if you see the options that government of India at the moment have limited. Okay. Because if you look at the MSP for the new crop, it is 2,100 to 50 for the price at which farmer is going to sell wheat to the government of India. And today price in Delhi is 3,200 rupees. That means we have to see inverse of around 30-35% in prices for prices to go back to MSP level. Today's stocks of government of India is around 17.1 million tons as against a buffer norm of 13 million tons. Government is comfortable on the stocks. Right. Even if I will put this way, it's going to take time, OMSs to come to the market, but government of India for sure should come with immediate OMSs policy to increase the availability of the wheat in the domestic market. Right. Because it's a small miller, it is suffering the most. Second, one important point I want to highlight, the consumer in the country, especially in the poorest part of the country, that's the West UP, Bihar, Bengal, Odisha, they are getting the least availability of food grains this year. Because when PMGKY is stopped or being renamed, the distribution in this part of the country has gone down substantially. Absolutely.
But Sumit, the other point really is about the farmers. With the farmers getting higher prices, do you think that at least that is one part that the government has got right?
Actually, if you look at post-harvest, it's never the farmer who is the beneficiary. In India, around 60 to 70% of the crop by farmers is sold at harvest, and especially in the commodities which are MSP driven, the selling is even higher. So farmer today, even if you look at the price of the new commodity, it is new harvest, it is 21,250, which is 30% lower than today's price. So either government of India has some magic wand in mind where they'll be able to buy a lot from the farmer. But in absence of that, we have a very, very tight rope to trade.
All right. Okay.
All right, Sumit, thank you so much for joining in. Sorry to cut you short right now on this one, because we have the Maruti numbers flashing for you at the bottom of the screen. On standalone net profit basis, it looks like a beat on street expectations. In fact, we were working with net profit growth of 88%, and it's come in much higher than that. Importantly, it's a revenue-led beat as well. In fact, the CNBC-TV18 poll was expecting a revenue of 27,300 odd crores. The company has gone ahead and posted revenues of 2,900 crores. And look at that stock spike. And it's a top-line led beat. Even the EBITDA has come in a little over 88 odd crores, just under 2,900 crores. So that means that the margins have met street expectations. 9.7% is the EBITDA margin that the company has posted. But on an absolute basis, this is a definite beat on both the company's revenue as well as the EBITDA, which has flown through to the bottom line. Just looking at these numbers, in fact, the volumes during the quarter were up by about 8% odd, 4.65 lakh units. And that's the number we had already. Okay, 2833 crores on the company's EBITDA, 29,000 crores plus on the company's revenues. And as a result of which, the net profit growing and, going above that 2,300 crore mark as well, much above street expectations. The street likes it, the stock at the high point of trade. We do have Ashwin Patil of LKP Securities joining us on the phone line on these numbers. Ashwin, initial numbers, what's your take? 29,000 crore plus on the top line, a little over 2,800 crores on the EBITDA, and the net profit around 2,300 crores?
Well, the numbers are quite, impressive this quarter around. Slightly about 3 to 4% above our estimate, and we think that it's a good set of numbers. The company, in this quarter have, it being a festive quarter, and though it was not a very good festive season, but for them it was, better than others. So about 8% kind of volume growth was seen in this quarter on a YOY basis. Also on a QOQ basis, the numbers were good. So I think that also the commodity prices have gone down. The company has launched a couple of vehicles in the earlier quarter, and that has started yielding to the volumes. So I think the operating leverage was also much better this quarter, and the discounting levels, we need to check out how much were they, but I think that they were not that high as well. So the margins have also come quite, at a good level. So on and on, I think it was a good quarter for them, and slightly above our expectations. But yes, I think that the company has done well on the volume front as well as the margins front.
Okay, yes, in fact, at 9.7% margins, this is the second consecutive quarter of 9% plus margins that Maruti is delivering, which is very good. Last quarter as well, in Q2, Maruti's margins were 9.3%. So this time at 9.7%, it is a 40 basis points higher, even on a quarter-on-quarter basis. So that's very good to know. And, even if you look at the consolidated EBITDA number, last quarter, the consolidated EBITDA for Maruti was 2,768 crores. And this time around as well, it's, I think I missed the consolidated EBITDA number. I think it's higher than what we saw last quarter. So good numbers all in all, much better than expected. And operationally, Maruti has improved quite a bit. If you remember, in last year, of course, it's not comparable year on year because, same time last year in Q2 and Q3, there was the whole COVID situation impacting earnings. But the margins had dwindled to as low as 4 to 6%. In Q2 of FY22, margins were 4.2%. In Q3, it was 6.7%. Since then, margins have staged a good recovery for Maruti. Of course, there's the raw material tailwind for sure. But even operationally, things are definitely improving. And I think that's something that the street likes.
Totally, Sonia. In fact, the material tailwind is something that has impacted their margins most favorably this time. They've given us the breakup of the margin benefit, and 310 basis points have come in primarily on account of favorable material costs. So material costs as a percentage of sales is 75.7%. Same time last year, this number was 78.8%. And the company says positive factors that impacted the margins were cost reduction efforts, improved realization, favorable foreign exchange variation, softening of commodity prices as well. The only negative factor, however, was higher sales promotion expenses. So that's the commentary that we have on margins so far.
Also, I just want to mention that the core EBITDA number at 2,833 crores is it's at a multi-quarter high. Now, last quarter it was 2,768 crores. So quarter on quarter, it's about a 2.5% up move. Just the core EBITDA number for Maruti. But if you look at it, on an average, the EBITDA has been anywhere between 1,900 to 2,400 crores. So at 2,833 crores, this is much higher than the average that we've seen in at least the preceding 5 to 6 quarters. I just wanted your thoughts, Ashwin, on how to approach the stock now. Because, there are many triggers for Maruti, right? They are getting into this SUV space in a big way. There are a whole host of new launches as well. The SUV market share, although is subpar, they're looking to grow it in a big way. Would you, based on these numbers, raise either your EPS estimates or your target price on the stock?
See, first of all, I would like to say that the supply constraint issue is also much behind us now, because almost about 95 to 100%, the pre-COVID levels the company has reached on that front. So that is one positive, biggest positive I would say, because that gives them the chance to launch very new vehicles and supply them to a good extent, because now their order book is also quite high, and also they are coming up with new launches. So that, gives them confidence and comfort to come up with, new launches and launch them and sell them at a good rate as well. So I think that coming 2 years will be very interesting for them from that point of view as well. And also the commodity prices are moving down. So, that gives them the advantage of the margins as well. So on both the fronts, like volumes as well as on the margins front, the company is, poised for a good FY24 and 25. So, I'm always positive on Maruti, like since last 3 to 4 years at least, and continue to be so with a target. With my current target is close to about 9,400. So I need to look at the numbers and maybe I may increase the target because we are rolling over to FY25 estimate.
Ashwin, on the order book itself, and this is a line that should come up for you on the screen as well. The company said the pending customer orders stood at about 363,000 vehicles at the end of the quarter, of which about 119,000 orders were for newly launched models. In the previous quarter, the numbers that we know already, they've sold 465,000 units. And by the end of the quarter, them sitting on 363,000 vehicles in terms of an order book, how do you read that? First to Sonia and then to Ashwin. Sonia?
Okay, so yeah, I just want to mention one more thing just before coming to that question. At 9.7% standalone margins, as I said, this is the second consecutive quarter of the margins going above 9%. And, there was 9.1% that they did in Q4 of FY22. After that, the margins fell to 7.2% and then a recovery. So this is important because, they had about double-digit margins way back in Q2 of FY21. So, Ashwin, you mentioned briefly that you're constructive on the stock and, you expect more upsides. But do you forecast Maruti getting back to 10% plus margins in this fiscal itself, maybe even in Q4?
Definitely. I think that in Q4, the company will be, in much better position because they are already catering to the order book very well, as, we have pointed it before. So I think, that gives them the comfort because the raw material prices are already moving down and operating leverage also is coming to play because they are catering to that kind of huge kind of number on the volume front. So I think 10% is quite easy for them to, just about 30 bips, sequential growth is required, and that is quite easy for them. In fact, I think that in FY24 and 25, 11-12% kind of margins are also quite possible for them.
All right. So that's what we have from Maruti so far. In case you've just joined in, the company's standalone EBITDA up 82% on, of course, a low base, but as against street expectations, 2833 crores, as Sonia has pointed out, is at a multi-quarter high. Margins at 9.7, 9.8% too have been much higher than what we've seen over the last couple of quarters. Improvement in raw material prices has led to that margin improvement for the company. The net profit too has been higher than expectations, and all of that has been led by revenues upwards of 29,000 crores, which is above street expectations. So a top-down beat from Maruti, positive commentary coming in, them sitting on an order book of 363,000 vehicles at the end of the quarter itself, and all of that bodes well for the stock at the high point of the trade, sitting with a gain of almost 2% on Maruti. With that, we wrap up on this edition of Halftime Report. Business Lunch comes up next.